Hey everybody, this is Ryan Mallory with SharePlanner.com, swing trading the stock market. In today's episode, we're going to talk about managing headline risk. I got an email from a guy, and we never use people's real names on here. I always tell people, hey, give me the name that you want me to call you by, or just give me a good Florida name. But in this case, he gives me his own name that he liked to go by, which he asked to be called Uncle Bubba. So we'll call him Uncle Bubba. Never used that one before. I've used Bubba, but not actually Uncle Bubba. But he asked some questions about headline risk as he's slowly getting back into the market and into swing trading again. So Uncle Bubba writes, hello, Ryan. Fellow Space Coast, Florida man here. That's great. You've had a Bubba in recent episodes, so please use my full name, Uncle Bubba. I'm a 50-something tech-savvy investor just returning to swing trading with a new focus and discipline. Your podcast has been both informative and affirmative. On every episode, I'm learning something new and reinforcement for things I've learned before, often the hard way. I work remotely and I do have time for research and listening, but reaction time during the active session varies greatly depending on meetings and workload. So I'm looking for multi-day long positions. I don't mess with options and haven't had experience yet with margin or shorting, sticking with the basics for now and taking it slowly and steady this time around. So I'm going to stop right there. I used to work in corporate America too. I quit a long time ago. I guess it's like a couple of decades ago now. But I used to work in corporate America, and it was a challenge. It was a huge challenge trying to be able to balance work life and work responsibilities with trying to be successful in the stock market. I struggled with that quite a bit. I always had one mind on what I was doing for my work and the other thinking about my next trade. And how I was managing the risk and so forth. And did that stop loss hit? Did I get filled? Because oftentimes I would be filled on my trades when I was in work meetings, and it could be really, really difficult at times, just trying to be focused on both aspects of life. So I get that and I always talk about this in my podcast, when you're developing your strategy for trading, you want to make sure that it's built around your lifestyle. I remember there was a time where I did futures trading when I was in corporate America, and it really didn't work. I mean, I had alerts going off all the time. People would be walking into my office, and I'd have a Buzz Lightyear sound going off for when I should get long on something, and I would have a Charlie Brown depressing alert sound going off when I needed to get short on something. And people were like, what are those sounds? What am I listening to here? And you didn't really want to tell them what you were doing, because then, a little too much curiosity in the workplace can do a lot of harm, when people start talking about what you're doing. So it's so important that the exact strategy you have is complementary to your circumstances, to your lifestyle. And that's one of the things that swing trading affords, is that it allows you to be able to customize your trading strategy around your lifestyle. So good questions. He wasn't really a question. He was more or less asking me building up to his actual questions, but I wanted to stop there and answer that one. So here's his questions. We've all heard buy the rumor, sell the news. But what if you want to avoid the news altogether? I know you don't hold through earnings. That's one of the things that I've had to learn the hard way. But what else do you do to avoid getting surprised by headline-driven price movements? Are there stocks that you count on as being less susceptible? Conversely, what do you do, if anything, to take advantage of the news? How about rumors? Are there stocks you monitor that will move reliably on new announcements or events? I'm glad to hear that you say you aren't monitoring CNBC these days and don't follow the self-promoting CEOs and bag holders. I've tried being a financial TV guy, and it just isn't for me. That said, I'm curious if there are some better sources for the same type of information that you do monitor or subscribe to, and what overall impact this has on your trades in addition to purely technical setups. Thank you for your good vibes and upbeat tone and touch of redneck presentation style. Thanks again. Much obliged. Uncle Buck. Okay, so there's a lot of good questions here. And even some questions, too, that he didn't necessarily ask, but I still think it's worth addressing. First of all, he talks about how he doesn't have much experience yet with margin or shorting. And I'll tell you this. You don't need to do those things in order to be successful in the stock market. A lot of people get way too leveraged to begin with. And that's a surefire way, especially early on in your trading, to blow up your account. And so you want to avoid that kind of trading mentality where you feel like you have to get leveraged. You have to get long to an extent that if you're wrong about the trade, it's going to completely blow up your account. You don't want that. And then the shorting. I think shorting can be a really helpful tool. I do it a lot, but I wait for the right conditions in order to do it. But I will also say this. To be successful in the stock market, even in bear markets, you don't need to be a person who shorts stocks. You don't have to do it at all. So you can really go through your whole trading career and not use margin or have to short. If you're shorting, you are using margin because you're borrowing the shares to short. But the reason why I say you don't have to short stocks, because in a bear market, some of the best long opportunities are actually in a bear market. Because when the markets bounce, those dead cat bounces, when they bounce, they can bounce like 5 to 10% within like a few days. The gains that you can make off of those dead cat bounces are insane. Even with like just stocks like Apple or Amazon. Now you can make a killing off of those. So you don't have to short stocks in order to be successful in the stock market. In fact, I would probably say for most people, you probably shouldn't even consider shorting at all, because one of the things that shorting will do is that it'll make you want to short when you shouldn't be, because there's that like contrarian nature in traders, I believe, that says that, I don't know, there's some kind of like dopamine or something that releases when you think that you're short when everybody else is long, and all of a sudden you're losing money when everybody else is making money, and that's like 10 times worse. So I don't think that you need to be short in the market if you don't have to be. Like I said, I do short stocks, but I do it far and few between when you compare it to how often I'm long on stocks. And that's because over time, the market historically goes up. You really just want to short stocks when the market is changing its tune, when it's trending lower, and when it's becoming much more bearish. With that being said, he says he also wants to take it slow and steady this time around. So this is like he's reemerging into the markets here, Uncle Bubba is. And he's wanting to take it much slower than he did before. And that's admirable. I think it's a thing of beauty to take it slow and to take it steady, because today the tendency is to be complex and leveraged. And we've taken trading and made it a much more of a casino type atmosphere. And that's a very dangerous approach to trading, because now it's not so much, is this a trade that I can manage the risk on? Is this a trade that's breaking out? Is this a solid trade setup? It's more about like, I'm buying in this stock because I believe in it. Apple's great. Nvidia's awesome. It's going to the moon. I'm getting long. I'm going to leverage myself. YOLO. That's the mentality with a lot of traders right now, is that there's not a lot of thought process into their complex trading and their over leveraged accounts. And so they're blowing up accounts daily. And right now we're in a bubble in this market. And what you're going to see even more as this bubble increases is the mentality and the mindset of these people are going to get far worse and far more sloppier. And so when everybody else is getting crazy with their trades, getting far too complex and leveraged, be like Uncle Bubba and take it slow and steady, because you'll stay in the game when you're taking it slow and steady, when you're making your trading boring and not an adrenaline rush, because the adrenaline rush folks, they're only in the market for a limited time. And I haven't even got to Uncle Bubba's questions yet, so I'm actually getting to him now. He said, we've all heard buy the rumor, sell the news, but what if you want to avoid all of these things together? Well, the bad part is that you really can't avoid them all together. I wish that was the case. I wish you could say that you could avoid all the headline risk events, but there's so many headline events nowadays that you really can't afford it to just be out of the market every time that there is a news report or a economic report that's being released. I mean, you think about it, you have the CPI, you have PPI, PCE, employment, jobless claims, GDP, you have the FOMC reports, you have the FOMC minutes, you have the beige book. I know I'm forgetting a bunch of them here, but there's so many economic reports and news events that are coming out that if you try to avoid them altogether, you're hardly ever going to be trading. So it's really just a fact of the matter that you have to put up with some of these headline events. Now, if there's a CPI report coming out at 8:30 the next day, am I going to probably, and it's historically been a volatile previous 2 or 3 CPI reports. Because the CPI report is not always volatile. I mean, until inflation started kicking in, people didn't really pay too much attention to CPI. But now we started getting inflation, like 7, 8, 9%. People are paying attention to, and by the way, I think inflation's way higher than what it was back in those days being reported. But when it is of a very volatile nature, yeah, I'm probably not going to go add a new long position right at 3:45 p.m., knowing that I'm only going to be in the trade for 15 minutes before it hits a major headline event. But if it's like a couple days in advance, I'm not going to sweat that too much, because I may have some gains beforehand that I can go ahead and lock in some of those gains and let the rest ride through that report. But sometimes though too, when you're in a bear market, those events, those headline events are much more volatile. So you take CPI during 2022 versus today. CPI today still can be pretty volatile, but it's nothing like it was in 2022. 2022, you could get 3, 4, 5% moves in the market because of the CPI report. So sometimes during those particular periods in the stock market, yeah, it's probably better to avoid some of those major drivers. Would I avoid, the employment report during 2022? Not really. Probably not even GDP, but CPI, definitely one that I tried to avoid, especially taking positions right beforehand. I did hold through CPI at times, but I didn't necessarily want to take new positions right before the CPI report came out. So you can't avoid the headline risk altogether. That's just not happening. Like I said, if you did, you'd never be able to trade. So his other question was, are there stocks that I can count on as being less susceptible to these headline risk events? You go back to 2022. That was the most recent, bear market that we had. When we were getting market bounces, oftentimes what I would do, I'd play like SPY, SSO, I would play UPRO, I would play some of the ETFs, and some of those were leveraged. And so depending on how I could, manage the risk, if the risk was tolerable, I would get into a little bit more of a leverage ETF, but I would still keep my same position sizes. But if I was playing individual plays, now remember, when you're in a bear market, stocks are declining much more usually than the overall market. You could have Apple down 30, 40% when the S&P 500 might be only down 25%. So when the market does start to bounce, I don't need to be jumping into something like SoFi or Square, SQ, or Mara, MARA. I don't need to be buying into those speculative names or more speculative names. I should probably get more into the more stable, more dependable names like Apple, like Amazon, like Google, Microsoft. Because if the market's going to truly bounce, those stocks are going to lead the way. The market's not going to be able to bounce if you have $10 trillion of market cap that's continuing to tank. So in order for the market to bounce, those names have to participate, and they give you a little bit more beta probably than the overall market, because that's the names that everybody else, especially on Wall Street, is going to be flooding into to put some capital to work. So those are the names. They're the ones that I feel like have better odds of participating in market rally, because the worst thing would be to time the bottom of a market and then you're right about it. And I don't believe that you time the bottoms necessarily. I think you want to wait for there to be a basing pattern for it to be showing signs that it's bouncing off of key support levels, something of a technical nature that you can manage the reward risk ratio with. You don't want to just say, oh, it's fallen far enough, I'm going to go ahead and get long here. You definitely don't want to do that. But what I don't want to have happen is for me to say, okay, the market's bouncing here, I'm going to go ahead and get long on Wayfair, or I'm going to get long on, I don't know, just some random, high growth stock. And then all of a sudden the market does bounce, but those stocks don't go anywhere. They fall apart still. That would be, to me, insanely frustrating and something I don't want no part of. I want to be in the Apples and the Googles and the Metas during those times, because when the market rallies, it's going to be because of those stocks that are taking off. So And that goes for like long-term investing too. When the market finally hits some historical lows or a major pullback, like what we saw in June and again in October of 2022. Yeah, I'm not looking to get into these like $100 million market cap stocks. I'm looking to get into the $1 trillion market cap stocks, the ones that have pulled back significantly. Those are the ones that I really want to be getting into. So conversely, he writes, what do you do, if anything, to take advantage of the news? How about the rumors? Are there stocks that you monitor that you know will be more reliable on new announcements or events? Well, like I said, I don't trade earnings at all. That's one of the events from an individual stock standpoint. I'll never hold a stock through earnings. Now, long-term accounts are different. You can't have a long-term account with stocks in it that you're holding for the long term unless you hold it through earnings, because you can't have a long-term stock unless you hold it for more than a year, and earnings happens every 3 months. So that's impossible. But from a swing trading standpoint, and this is what this podcast is about, I never hold a stock through earnings. Now, you'll see through different periods of time, there's different themes in the market. Like, for instance, in 2023, it was all about how much is the Fed going to be cutting rates in 2024. And so as those odds for more rate hikes or rate cuts increased, the market started to rally. And the market would rally off of those expectations for future rate increases. So if we got a good economic report that showed inflation was coming down, then all of a sudden people would price in 2 or 3 more Fed rate cuts for 2024. Now, we only got, like 4 of them here in 2024. We got 3 so far and 1 more possibly, which would be the 4th one expected in December here. However, at the time, the market was rallying on those expectations for, 6, 7 rate cuts in 2024. So as the market's running higher on the rumors of those rate cuts, you can benefit from that, but you don't want to be sold out to it. And yes, there is a buy the rumor, sell the news kind of effect in the market, to where when the reality of those rate cuts start to kick in, or if any news event starts to kick in, there tends to be more profit taking, whereas the money was made in the run up and pricing in those the reality of that news event. So buying the rumor, sell the news is definitely a reality in the stock market. Again, Uncle Bubba here is asking a lot of important questions, and we're talking about the Fed rumors, the FOMC rumors, but one of the other things too that I would tell him is that when it comes to themes, and you'll see this in the upcoming Trump administration, because he does a lot of things that does impact the stock market, can make it very difficult at times too, just from a day-to-day basis, because if he puts a tweet out, that can rock the markets. You'll see a lot of people say, what did he tweet now? Because he'll say something about tariffs and it'll instantly cause the market to go down, and vice versa. He could say something like, trade war solved or fixed, and all of a sudden the market will take off out of nowhere. But you'll start to see, like, when we get into the tariffs, he'll tweet something out about the tariffs inevitably, and that will cause the market to go down. And then you'll start seeing the headlines of improved relations or increased optimism about trade relations between the United States and China. And all of a sudden you'll start seeing the market rallying again. And so they will keep recycling the headlines. And that could be a really frustrating thing for shorts, is because when they're on the short side of these headlines and these rumors, they're like, they said the same thing yesterday. Why is the market rallying on the same news as the day before? It makes no sense. And that's true. You will get those kinds of events where the market's where it feels like the market's rallying off of the same news as it rallied off of before, but that's just part of the cycle. Yes, they do recycle headlines, but you will see those rumors kicking in, especially during the Trump administration, where he's taken a hard line approach because the market does react to tariffs. You will see that there is some heavy movement to his tweets and to what he's doing on the trade relations standpoint as it pertains to tariffs. He told me that I'm glad you're not listening to CNBC. I don't listen to CNBC at all. I used to even turn it on for the FOMC statement and to listen to the presser. I can't do that now either. I really don't. I may just like stream it through like Twitter, or x.com, which I love. I think X is probably one of the best sources for stock market news. Some people may not agree with that, but for me, I find that it's far more instantaneous than anything that you're getting off of CNBC or Bloomberg. Now, there is the Bloomberg terminals, which are, extremely pricey. I think they cost something like $25,000 a year. I don't have one. I don't rely on the news. So I think the other thing too is not being too beholden to news events. Whereas, yes, earnings, that's a news event. I'm not, stepping foot into an earnings report with an individual swing trade. But just in general, having that TV on and trying to trade off a headline news, when those news events kick in or when you see them, they're already getting priced in far before you ever saw them. And so you'll see these algorithms. People aren't even reading the news reports. The algorithms are reading and responding instantaneously to them, the machines. And I think you'll see more of that as AI continues to progress. They'll be incorporating AI into it. And so they'll be relying on AI to make some of these trading decisions for them, which is kind of scary. You just don't know what that entails. I think you'll see a lot of fat finger trades as a result of AI in the decade ahead. But for us as commoners, I don't think there's a lot of benefit to having a real-time news feed. I use x.com. I think that's good. I think Thinkorswim has a pretty decent news feed as well. But X, usually I can find out most, especially as it pertains to market-related events, it provides some really fast news. So, yeah, I would say x.com is my preferred news source. Now, some of you guys might be traders like, what, you don't have a Bloomberg terminal? No, I don't need a Bloomberg terminal. It's really just wasting money if I was to get into a Bloomberg terminal. There's no real reason for that. Is it fancy? Yes. Do I wish I had one? Yeah, it'd be pretty cool. I could probably make some pretty cool charts and tweets out of it, but in all, I don't think it's really worth my time. So, in any case, we talked about a lot here. One of the things that I always like to tell you is that you need to check out swingtradingthestockmarket.com. That's going to give you an opportunity to get all my stock market research for free each and every day. That's going to be videos for tons of videos, actually, multiple videos each day. You're going to get stock market updates on all the mega cap stocks like Meta, Apple, Amazon, Nvidia, Google, Microsoft, Eli Lilly, Tesla. I do updates on those throughout the week, do stock market updates. Plus, I give you my daily watch list of stocks that I'm looking to potentially trade. And I do watch list reviews. Send a video out on the watch list each afternoon telling you what I think worked, what didn't work, what I'm looking at in each of the trade setups that I posted from that morning. And I have a master watch list that I send out at the beginning of each week showing you all of the stocks that I'm following to curate potential setups from. So check that out, swingtradingthestockmarket.com. And make sure to leave me a 5-star review on whatever platform you're listening to me on. If it's YouTube, make sure to like and subscribe. If it's Spotify, yeah, just leave a review. I always appreciate those, especially when they're 5 stars. Those mean the world to me. And if it's on Apple, same thing. And make sure to send me your questions, Ryan@SharePlanner.com. I can't tell you enough how much I appreciate the emails. Like, this one from Uncle Bubba here. He sent me a great question, lots of stuff and material to cover on that, and I hope I did it justice. But tell me your stories, tell me your backgrounds, what's perplexing you, what's troubling you. I want to hear about it. Thank you guys, and God bless.